it's very likely that setting requirements on banks to use more equity funding than they would themselves choose is nearly always going to be optimal. There are two ways broadly that banks can finance themselves, just like any other company, any non-financial company. They can issue debt, they can use equity. And the key characteristics of debt are that you promise to pay a certain amount back, and if you as a company do less well or more well, that shouldn't really affect the amount that the people who provided the debt get. On the other hand, the equity holders, their return is very much dependent on how successful the company has been. And the equity stands there as a buffer, in a sense, to prevent good or bad performance of the company from affecting the returns to debt. Banks specialize in acquiring information about the creditworthiness of the people they lend money to. But what it means is they end up with a lot more information about the nature of the loans they make than outsiders themselves have. So there's a degree of asymmetric information which I think is unusually acute in banking. Banks also, like companies in general, have limited liabilities. What that means is that the shareholders that help fund the activities of banks, the worst they can do is lose their money. The combination of limited liability and asymmetric information can give banks who are acting in the interest of their shareholders an incentive to take more risk than they would in an ideal world. And what we show in the piece of research that I've been discussing is that gives an incentive for banks to take too many risky loans on, maybe to make too much lending, and generate outcomes that are inefficient in that sense. I think one of the takeaway is that you very likely do need a set of capital requirements, by which I mean a set of rules which force banks to use more equity funding than they might, left to their own devices, choose themselves. And that really is the major lesson here. There's a subsidiary lesson, which is that as well as using those equity requirements or capital requirements, there may be circumstances under which the central bank may want to set higher levels of interest rates than it would in a world in which these banking problems didn't exist.